Accounting 222. Public Sector Accounting. Study Session 1. Budget in Public Sector. Introduction. Public budgeting is a field of public administration and a discipline in academic study. In this study session, you will learn about budgeting and control in the public sector. You will also be introduced to budget types, uses, preparations, and implementations in the public sector. Meaning of budget. A budget is a comprehensive and coordinated plan, expressed in financial terms, for the operations and resources of an enterprise for some specific period in the future. Functions of a public budget. Some of the functions of a public budget are: 1. It is used as an instrument of economic and social policy. 2. It is used as a planning tool. 3. It is used as a means of communication. 4. The public budget serves as a legal document. Methods of budgeting. There are different types of budgets. Within the framework of government budgeting, the following types of budgets are clearly identifiable. 1. Line item budgeting. The method of preparation of the annual budget could depend on: 1. Whether the emphasis is on the nature of the income and expenditure. 2. The purpose of the expenditure. Advantages of line item budgeting. 1. It helps to control fraud by limiting expenditure to the amounts and to items voted in the budget. 2. It provides flexibility when across-the-board cuts have to be made for macroeconomic purposes. 3. It is simple to operate. A lot of Nigerians will be able to understand it. 4. It aids planning and comparison. 2. Incremental budgeting. This is a budgeting approach in which the current year's estimation made of income and expenditure are used as the starting point for ascertaining the budget for the next year. Advantages of incremental budgeting. 1. Most of the activities carried out in previous years are either mandatory, or are so crucial to meeting organizational goals, that they must continue every year. 2. Another advantage is the bounded rationality argument. This arises as a result of the complexity of the budgetary process. 3. It is argued that the limits on decision-makers' knowledge, in negation formation, and cognitive ability mean that aid to calcul and negation science such as incremental budgeting is necessary. 4. Incremental budgeting narrows the areas open to dispute, thereby reducing conflict. Disadvantages of incremental budgeting. 1. It is usually prepared for a short period of time. 2. It does not lend itself creditably to monitoring. 3. It is based on financial inputs and not on the output of services, which these inputs are intended to serve. 4. It is not continuous throughout the year. This creates distortions to the utilization of staff. 3. Zero-based budgeting. Zero-based budgeting is a systematic budgeting system, which requires 5 basic steps in its implementation. 1. Specify the decision units. 2. Define decision packages. 3. Evaluate and rank packages. 4. Drop unworthy activities. 5. Allocate resources. Advantages of zero-based budgeting. The following are the advantages of zero-based budgeting. 1. It does not assume that last year's allocation of resources is necessarily appropriate for the current year. 2. It forced managers at all levels to identify their specific objectives, quantify them, and evaluate the cost-effectiveness of the alternative ways of achieving them. 3. It provides a yardstick for the measurement of performed negation ends. 4. It encourages greater participation by managerial negation science and lower levels and develops a more critical and better motivated approach by them. Disadvantages of zero-based budgeting. The following are the disadvantages of zero-based budget. 1. Problem of identifying suitable decision units. 2. Problems of producing suitable decision packages, which are self-contained and understood by managers. 3. Short-term benefits might be emphasized to the detriment of long-term benefits. 4. It is a call for management skills and decision analysis, to construct decision packages, which the organization may not possess. 5. A large amount of staff time, and organization is necessary to introduce the system. Definition of planning, programming, and budgeting system. It is a budgetary process designed primarily to make government and public corporations' activities more effective and more efficient. Programming and budgeting system comprises 5 basic elements. 1. Programming. 2. Identification of objectives of each program. 3. Measurement of the outputs. Planning, programming, and budgeting system expressions. 1. Expressions by objective. 2. Expressions by program. 3. Expressions by output. 4. Expressions by alternative approaches. Advantages of planning, programming, and budgeting system. 1. It provides information on the objectives of the government. 2. It cuts across conventional lines of responsibility and delegation-compartmental structure by drawing together the activities that are directed towards a particular objective. 3. It exposes programs that are overlapping or contradict negatory in terms of achieving objectives. 4. It concentrates on long-term effects, along with short-term operational needs. 5. It enables resource allocation choices to be made on the basis of benefits or costs. Disadvantages of problems of PPBS. 1. Resistance to change may be encountered particularly among elderly officers. 2. The PPBS is information intensive. 3. Time constraint. 4. Insufficient and unreliable database confronting most developing countries. Differences between zero-based budgeting and planning, programming, and budgeting system. 1. Zero-based budgeting appraisal can rank projects using cost-benefit analysis, whereas planning, programming, and budgeting system does not. 2. Zero-based budgeting allocates resources to each of the projects based on their rankings. 3. Planning, programming, and budgeting system identify and examine the goals and objectives in each area of government activities. 4. Zero-based budgeting, on the other hand, will not only identify and examine them but will break them down into smaller achievable decision packages. 4. Rolling budget. A rolling budget is defined as the continuous updating of a short-term budget by adding, say, a further month or quarter and deducting the earliest month or quarter so that the budget can reflect current conditions. A rolling budget is called a continuous budget. Advantages of rolling budgets. 1. They reduce the element of uncertainty in budgeting. 2. They force managers to reassess the budget regularly and to produce budgets. 3. Planning and control will be based on a recent budget instead of fixed budget that might have been made many months ago and which is no longer realistic. 4. Realistic budgets are likely to have a better motivational influence on managers. 5. There is always a budget, which extends for several months ahead. Disadvantages of the rolling budgets. 1. More time, money, and effort are spent. 2. Frequent budgeting might have an off-putting effect on managers who doubt the value of preparing one budget after another at regular intervals. 3. Revision of the budget might involve revision standard costs too, which in turn would involve revisions of stock valuations. 4. If the expected changes are not likely to be continuous, routine updating of the budget is unnecessary. In this study session, please note the following. Meaning of budget. A budget is a comprehensive and coordinated plan, expressed in financial terms, for the operations and resources of an enterprise for some specific period in the future. Methods of budgeting. 1. Line item budgeting. 2. Incremental budgeting. 3. Zero-based budgets. 4. Planning, programming and budgeting system. 5. Rolling budget. Incremental budgeting. This is a budgeting approach in which the current year's estimation made of income and expenditure are used as the starting point for ascertaining the budget for the next year. Study Session 2. Government Budget 2. Introduction. In this study session, you will learn about the structure of the public sector budget, which may be substantially different from what is obtained in the private sector. You will also be introduced to the problems of public sector budgeting in Nigeria. Budget Preparation Procedure. The budget preparation procedure at the federal and state government levels could be divided into 4 broad stages, namely: 1. The budget drafting phase. 2. The legislative phase. 3. The implementation phase. 4. The auditing phases. Delayed budget. As stated earlier, the Constitution did not specify the time the President or Governor must present the draft budget to the Parliament in any year. Also, there is no time limit for the legislature to consider the draft budget submitted to it. The implication of the above is that sometimes, the budget may not have been approved at the beginning of a financial year. Section 82 of 1999, the Constitution makes provision for the withdrawal of money from the Consolidated Revenue Fund of the Federation necessary to carry on the services of the Federation, pending approval of the budget. The authority granted to the executive is, however, subject to the following. 1. Supplementary estimate. 2. Base estimate. 3. Committed growth. 4. Vehement estimate. Structure of the budget. There are 4 basic parts to the public budget. 1. Revenue budget. The purpose or function of the revenue budget. 1. To plan the cash flow of the government. 2. To identify the major sources of government revenue. 3. To determine the income to be received by the government. 4. To determine the weaknesses in the revenue generation base with a view to improving on it. 5. To make policies on the revenue generation of government. 2. Capital receipts. The capital receipts budget of a state is usually made of 1. Internal loan. 2. Transfer from the recurrent budget surplus. 3. Transfer from general reserve. 4. Transfer from the specific reserve. 5. External loan. 6. Grants. Personnel cost budget. The personnel cost budget is an estimate of the total basic salaries and allowances of the various categories of staff in the employment of the public service. In preparing the personnel cost budget, the following basic steps are followed. 1. The identification of the various positions in each ministry department of government. 2. Identification of the number of staff in each grade. 3. Identification of the grade level of each position. 4. The identification of the basic salary and the annual incremental salary. Overhead cost budget. The overhead cost budget is presented in the same format as the revenue budget. And like the revenue budget, it is divided into heads and subheads. Overhead cost items include 1. Transport and traveling. 2. Utility service. 3. Telephone and postal service. 4. Stationery. 5. Maintaining office furniture and equipment. 6. Maintenance of vehicle and other capital assets. 7. Consultancy service. 8. Training and staff development. 9. Entertainment and hospitality. 10. Contributions and intentional organizations. Consolidated Revenue Fund charges. The third main head of the recurrent expenditure budget is the Consolidated Revenue Fund charges. Typical Consolidated Revenue Fund charges for a state-governed engagement include the following. 1. Personal emoluments for the following statutory office holders. 2. Pension and gratuities. 3. Public debt charges, internal and external loans. 4. Contractual obligations. 5. State government contribution. Capital budgets. Most public sector organizations make a distinction between items of revenue or current nature and items of a capital nature. The usual distinction between capital expenditure and revenue expenditure is that capital expenditure provides benefits for more than 1 year. This is known as the period of benefit principle. The benefit flowing from revenue expenditure is limited to 1 year. Sometimes this distinction runs into a problem. The objectives of capital budgeting. Some of the objectives of capital budgeting are: 1. A capital budget program is used to define the priorities between the services offered by a public sector entity. 2. It is an essential tool for the assessment of the availability of capital resources such as staff, land, and finance. 3. It serves to meet the requirements of the government's capital control system. 4. It serves to assess the extent to which an entity can meet the revenue consequences of proposed capital projects. 5. It serves as an authority for the officers to undertake the action necessary to implement individual capital projects. The form of capital budgets. The Planning Commission usually gives guidelines for the preparation of capital expenditure estimates. The guidelines for the preparation of capital budgets by government entities usually include the following, among others. 1. The capital expenditure proposals are to be in harmony with the set objectives and priorities of the government. 2. Only projects and the programs within the relevant rolling plan period are expected to be included in the current year's capital budget. 3. The provision of an enabling environment for industrial development is sometimes accorded priority. 4. Adequate financial proposals are usually made for the payment of counterpart funding obligations in respect of externally assisted projects/programs. 5. Also, attention is also focused on the maintenance and rehabilitation of economic and social infrastructure such as roads, water, electricity, education, healthcare delivery, etc. Capital receipts. Broadly speaking, capital receipts are those items, which are basically of non-repetitive and non-routine variety. The usual items of capital receipts in a state government budget include: 1. Transfer from consolidated revenue. 2. Internal loans. 3. External loans. 4. Miscellaneous. 5. Grants, from the federal government and international organizations. Capital expenditure. Capital expenditure is one whose benefits are likely to flow in for a period of more than 1 year. In government budgeting, capital expenditure is usually classified according to the sector. Typical items under the capital expenditure budget for a state government in Nigeria include: 1. Economic sector. This sector includes livestock, forestry, industry, agricultural and rural development, energy, commerce, cooperative and finance, and transport. 2. Social sector. These include education, health, information, sports, and social development. 3. Environmental development sector. This includes water resources and water supply, rural water sanitation, sewage and drainage or environmental protection, housing, and town and country planning. 4. General administration. This includes administrative buildings and others. Problems of public sector budgeting in Nigeria. A number of factors are responsible for this. 1. Behavioral factors. 2. High degree of environmental turbulence. 3. Dearth of reliable data. 4. Inconsistent government policies. 5. Fiscal indiscipline. In this study session, please note the following. 1. The budget preparation procedure at the federal and state government levels could be divided into 4 broad stages, namely, the budget drafting phase, the legislative phase, implementation phase, and the auditing phase. 2. Delayed budget. As stated earlier, the Constitution did not specify the time the President/Governor must present the draft budget to the Parliament in any year. Also, there is no time limit for the legislature to consider the draft budget submitted to it. 3. There are 4 basic parts to the public budget, which are: recurrent revenue, recurrent expenditure, capital receipt, capital expenditure, and capital budget. 4. The personnel cost budget is an estimate of the total basic salaries and allowances of the various categories of staff in the employment of the public service. The government operates a salary structure in which the salaries and allowances payable to the various categories of staff are well stated. Study Session 3. Financial Reporting in the Public Sector. Introduction. In this study session, you will learn about government financial statements, accountability in government and the need for accounting, and the preparation of financial statements. Users of financial statements. The users of financial statements of government can be grouped into internal and external. 1. The internal users include members of the executive, policymakers, and implementation, members of the legislature, various department heads, and government cooperation, and extra-ministerial development. 2. External users include the public, investors and creditors, students, professional groups, and other analysts, accountants, economists, journalists, other states, federal and other nations, foreign investors, etc. Characteristics of financial statements. It must be emphasized that for financial statements to be meaningful, they must: 1. Be easily understandable by all interests. 2. Report on all the major facets of the activities and operation of government. 3. Be timely presented. 4. Contain information for decision-making. Accountability and need for accounting. Accountability refers to the act of stewardship and involves the process of explanation for the use of resources by those entrusted with the resources. At this point, your attention is required to the need for accountability, which is viewed by Stewart as comprised of 2 distinct components: the rendering of accounts and holding to account. The holding to account involves the exercise of judgment and power over public officials. Preparation of the financial statements. In preparing the financial statement, the following statement of account are considered, which include: 1. Statement of Consolidated Revenue Fund. 2. Statement of Capital and Development Fund. 3. The Statement of Assets and Liabilities. In this study session, please note the following. 1. How demonstrated that in the Nigerian public sector, transactions are accounted for and financial statements are prepared periodically. 2. You must identify the users and uses of financial statements as well as the characteristics of financial statements. 3. In its quest to conform to international best practices, Nigeria adopted the IPSAS and has started the implementation of IPSAS cash basis of accounting. Study Session 4. Accounting for Price Level Changes. Introduction. The amount that appears in a set of financial statements is measured in units of currency, and it is generally believed that the value of the currency being used is generally stable. This implies that the value of 1 naira at the start of a period is the same as the value of 1 naira at the end of the period. Historical cost accounting. The term historical cost accounting refers to a system of accounting based primarily on the original cost incurred in a transaction, and no attempt is made to adjust the recorded amounts to take account of inflation. This approach is primarily used in practice. This approach is noted for the following advantages. 1. Objectivity. 2. Easy to apply. 3. Difficult to falsely manipulate. 4. Suitable for audit verification. 5. Fulfill the stewardship function in time inflation. However, the resulting historical cost accounting financial statements suffer from a number of weaknesses. This include: 1. Profit are overstated. 2. Depreciation charges are inadequate. 3. Gains and losses on monetary items are not disclosed. 4. Reported non-current assets are unrealistic. 5. Accounting ratios are misleading. Inflation and accounting information. Inflation refers to a general increase in price in an economy and consequent fall in the purchasing value of money. According to Acorier, inflation occurs when the volume of purchasing power is persistently running ahead of output of goods and services, so that there is a continuous tendency for prices both of commodities and factors of production to rise because they fail to keep pace with the demand for them. Characteristics of inflation. 1. Wealth is preferably kept in no monetary. 2. Monetary amounts and prices are preferably kept and quoted in a more stable currency. 3. Interest rate and price are linked to a price index. 4. The cumulative inflation rate over 3 years is the approach or exceed 100%. 5. Credit sales and purchase takes place at a price that compensates for the expected loss of purchasing power during the credit period. Alternatives to historical cost accounting. In the face of redeeming the accounting profession from the embarrassment fueled by the weaknesses of the historical cost accounting as mentioned earlier in the course of this study, the need to search for an alternative approach in curbing inflation is therefore inevitable. The proposed alternative methods are: 1. Current cost accounting. 2. Current purchasing power. In this study session, please note the following. 1. Historical cost accounting records each transaction at its monetary amount at the time that the transaction occurs and makes no attempt to adjust for inflation. In time of inflation, profit is overstated using the historical cost method. Despite the weakness of the historical cost method, it is still generally in use. 2. The alternative approach to the historical cost method is the CPP and the CCA. Study Session 5. Government Contracts, Advances, and Procurement. Introduction. In this study session, you will learn the meaning of construction contracts, procedures for awarding contracts and making procurements in the public sector, contract payment vouchers, and many more. Contract payment voucher. All payment vouchers relating to contract awards should contain the following information. 1. The names and address of the contractor. 2. Contract number. 3. The vote of charges. 4. Description of projects. 5. Certificated number being paid. 6. The authority for payment. Payments for contracts and procurements. The federal government's policy from January 2009 is that public funds would henceforth be made electronically. Payments are henceforth to be effected to the contractors by electronic transfers to their bank accounts. Implementation of the e-payment procedure. 1. All forms of payments from all government funds are to be made through the banks, either commercial banks or Central Bank of Nigeria. 2. All organs of government, ministries, departments, and agencies are to stop using checks to make payments to contractors. 3. All bank accounts in respect of all government funds shall cease to be check accounts. 4. Government contractors must indicate their current accounts particulars with commercial banks on the invoices submitted for payment under their corporate seals. 5. Mandates containing details of payments shall be issued to banks authorizing them to pay into the contractor's designated bank accounts, the proceeds of executed contracts, and supplies. Contract register. The register will contain the following information. 1. Contract number. 2. Contact sum. 3. Payment terms. 4. File number. 5. Name and address of contractor. 6. Completion period of contract work. 7. Signature of officer controlling expenditure. Attachments to contract payment vouchers. Before a contract payment voucher is processed for payment, the following items should be ascertained and attached. 1. A copy of the minutes of the tenders board awarding the contract. 2. A completion certificate of work done, signed by a competent authority in the field. 3. A copy of each of the letters of award and contract agreement. 4. In the case of supplies, original copies of delivery notes and store receipt vouchers issued. 5. A bill or invoice submitted by the firm requesting payment. The Tenders Board on Contracts. A tender is a proposal for the supply of some services or goods. It is usually made and presented as a result of an invitation. It is legally accepted as an offer for acceptance. The Tenders Board is the assemblage of public officers constituted to handle public tenders in respect of all government contract works. Types of Tenders Boards. The Departmental Tenders Board and the Federal Tenders Board have been abrogated. The functions are now assumed by the Permanent Secretaries and Ministerial Tenders Board, respectively. The composition of the Tenders Board. The following are the composition of the above ministry. 1. The Chairman of the Armed Forces or Ministry of Defense Tenders Board shall be the Permanent Secretary, Ministry of Defense. 2. Other members are representatives of the Army, Navy, Air Force, and the Director of Finance and Accounts of the Ministry of Defense. 3. The decision of the Armed Forces or Ministry of Defense Tenders Board shall be subject to the confirmation of the Minister of Defense. Nigeria Police Tenders and Purchasing Board. According to government financial regulations, the composition of the board is: 1. The chairman shall be the Permanent Secretary, Police Affairs. 2. The Deputy Inspector General of Police Finance and Administration. 3. All the heads of departments. 4. The head of Finance and Accounts Department. Powers of boards of corporations and parastatals over tenders. 1. The chief executive of a parastatals is empowered to make purchase or award a contract, the value of which does not exceed 700,000 naira only, without open competitive tendering. 2. Any contract exceeding 700,000 naira but not more than 20 million naira shall be referred to the board of the corporation, for approval. 3. Any contract whose value exceeds 20 million naira but not more than 50 million naira shall be referred to the Ministerial Tenders Board of the relevant supervising ministry or corporation and parastatals. Interest on delayed payment. There shall be a provision of interest payment to contractors for delayed payments by ministries or extra-ministerial departments. Such payment should however be made: 1. At the interest rate specified in the contract agreement. 2. If there is a delay in the settlement of the claim of more than 60 days, from the date of submission of the contractor's invoice or valuation certificate and the confirmation or authentication by the relevant ministry. Registration of contractors or suppliers. All eligible contractors, or suppliers must be duly registered with the Federal Ministry of Works and Housing, or their respective ministries, or extra-ministerial departments. They must produce their VAT registration certificates before registration. Audit inspection. The following must be forwarded to the Auditor General for the Federation. 1. Certified true copies of all contract agreements. 2. The minutes of Tenders Board meetings. 3. Full records of all tendering processes. Award of the contract. The approving authority will communicate his position to the Tenders Board. The Secretary will subsequently write a letter of award to the successful tenderer and/or invite him for the signing of the contract. Post-contract award activities. 1. Tender Board information on voucher. 2. Tenders Board information availability. Terms on contract. 1. Contingencies clause. 2. Retention fee. Due process guidelines on government contracts. The doctrine of due process is an assurance that there is compliance with the budgetary, procuring, and payment guidelines by all parties to government contracts. The process ensures that: 1. Competitive bidding has been conducted in line with the procurement and contract award procedures. 2. The best evaluated bid is selected among the pre-qualified bidders. 3. The cost is in conformity with the comparable best value. In this study session, please note the following. 1. The federal government's policy from January 2009 is that public funds would henceforth be made electronically. Payments are henceforth to be effected to the contractors by electronic transfers to their bank accounts. 2. A tender is a proposal for the supply of some services or goods. It is usually made and presented as a result of an invitation. It is legally accepted as an offer for acceptance. The Tenders Board is the assemblage of public officers constituted to handle public tenders in respect of all government contract works or services. 3. The chief executive of a parastatal is empowered to make a purchase or award a contract, the value of which does not exceed 700,000 naira only, without open competitive tendering. 4. All eligible contractors or suppliers must be duly registered with the Federal Ministry of Works and Housing or their respective ministries or extra-ministerial departments. They must produce their VAT registration certificates before registration. 5. The approving authority will communicate his position to the Tenders Board. The Secretary will subsequently write a letter of award to the successful tenderer and/or invite him for the signing of the contract. Where necessary, a bond will have to be signed and/or sureties provided. Study Session 6. Public Debts and its Management in Nigeria. Introduction. Debt arises when the resources available to the government fall short of resources available to meet the government expenditure. In Nigeria, the Debt Management Office in the Presidency is the recognized body set up to manage the nation's public debt with the assistance of the Central Bank of Nigeria. Internal or domestic debt. Nigeria has contracted a number of domestic debt obligations, which can be classified into two major groups, discussed as follows. 1. Internal debts contracted through financial instruments. 2. Trade-related instruments of domestic borrowing. The most frequently used of instruments are discussed as follows. 1. Treasury bills. 2. Treasury certificates. 3. Government development stocks. 4. Revenue bonds. Causes of domestic debt. The rapid increase in the stock of domestic debts is caused primarily by the need to 1. Finance current expenditure in anticipation of reasonable revenue collection. 2. Finance government budget deficit. 3. React positively to increased socio-economic responsibilities. 4. Cope with the sharp decline in government revenue. 5. Commit short and medium-term loans to long-term project. 6. Shift from official to private sources of credit which attracts a higher interest. Management of internal or domestic debt. The management of domestic debt by the federal government is a statutory obligation of the Central Bank of Nigeria, but which is now handled by the Debt Management Office in the Presidency. It is the central bank that is entrusted with the issue and management of federal government loans publicly issued in Nigeria, upon such terms and conditions as may be agreed between the federal government, the banks, and the contractors. General causes of public debt. At independence, African governments had little choice but to increase expenditure, even if they had to borrow, for survival and developmental projects. The following reasons justified the need to borrow so heavily. 1. Increased population, with the attendant responsibility to cater to the welfare of the people. 2. Need to provide infrastructural amenities in cities and villages. 3. The problem of urbanization. 4. The pace of industrialization. 5. Provision of social security, state security, health, education, etc. 6. Inability to collect revenue efficiently. 7. Need to provide employment, improve the standard of living, and general economic well-being of the citizens. Consequences of public debt. 1. Funding excessive interest rate on public debt is in hard currency which poses a serious burden on the government and the society at large. 2. Capital repayment presents serious imposition on the economy, since government must find the means to repay. 3. Borrowing makes the government have more cash to fund its various expenditures. 4. The problem of committing short and medium-term loans to long-term projects. 5. Several economies are characterized by heavy dependence on one or a few agricultural and mineral products. 6. Borrowed funds were not used to finance economically viable projects. 7. Occurrence of natural disasters such as persistent drought, desertification, and decimation of crops. Approaches to solving debt problems. As part of the efforts to reduce the burden of debt, the following measures have been taken in recent years. 1. Placement of embargo on new loans to prevent additional debt burden and fixing the maximum level of debt commitment for federal and state governments. 2. Reduction of importation of non-essential items. Causes of debt crisis in Nigeria. The major causes of debt in Nigeria include the following. 1. Change in the economic fortune in the oil sector. 2. Nature of Nigeria's economy. 3. The shift from official to private sources of credit. A debt is considered internal or domestic if owned to the residents of a county and external, if it is owned to other nations. It is worthy to note that public debt applies to every country under the surface of the earth. Countries depend on one another to survive. In this study session, please note the following. 1. Domestic debt is classified into two groups. These groups are debt contracted through the domestic instruments and the trade-related debt owed directly to contractors and suppliers. 2. The instrument of domestic debt consists of treasury bills, treasury certificates, government developmental stock, and revenue bonds. 3. The courses of domestic debts in the general form and specifically in Nigeria. 4. The management of the public funds is a statutory obligation by the Central Bank of Nigeria and handled by the Debt Management Office. 5. In order to solve debt issues, certain approaches are used. Such approaches are placement of embargoes on new loans and the reduction of the importation of non-essential items. Study Session 7. Progress in Public Sector Accounting. Introduction. This study session examines emerging issues in public sector accounting as of today. Starting from the 1950s to date, there have been emerging issues in public sector accounting in areas of accountability and auditing. International Public Sector Accounting Standards. International Public Sector Accounting Standards (IPAS) is issued by the International Federation of Accountants Public Sector Committee. It is necessary to, first of all, discuss the major impacts of IPSAS on an organization's accounting and financial reporting. 1. With respect to liabilities for after-service medical coverage and termination benefits, will require to be fully recorded in the financial statements. The current practice of amortizing unrecognized past service costs over several biennials will be discontinued. 2. Capital assets such as buildings, vehicles, furniture, and equipment will be required to be recognized and depreciated in the financial statements. The current policy of fully expensing the cost of these items at the date of acquisition will be discontinued. 3. Inventories will be recognized for goods received but not yet delivered out or consumed. Assets will increase as inventories were not previously recognized in the financial statements. 4. Provisions for delays of member contributions would be made based on an assessment of collectability. The current policy of 100% provisioning of contributions receivable will be discontinued. 5. Financial statements must be prepared and audited on an annual instead of on a biennial basis. Budgeting and donor reporting are impacted by the introduction of IPSAS for financial reporting. Financial reporting recognizes expenses on the same basis. This is often referred to as cash, modified accruals basis. The adoption of resource accounting in the UK central government. The following resource in accounting implies: 1. Identifying outputs and the process by which they are produced. 2. Classifying and valuing all assets. 3. Compiling and publishing a balance sheet showing assets, depreciation, stock, debtor, and creditor. 4. Reconciling resource flow and funding. Developments in public sector accounting in Nigeria. As of today, the modified accrual basis of accounting alongside the cash basis is expected to be in use in the Nigerian public sector. This is a step in the right direction in terms of progress in public sector accounting. The point is that, public sector accounting in Nigeria is moving from a cash basis of accounting to include accrual accounting basis, and public sector accounting in Nigeria is also moving from cash budgeting to accrual budgeting. Likewise, public sector accounting has moved from separate financial reporting to the consolidated financial statement. This is good for public sector accounting in Nigeria. Supreme Audit Institutions and International Standards for Supreme Audit Institutions. It is said that as of today, Supreme Audit Institutions in Nigeria are yet to adopt the international standards for Supreme Audit Institutions. And even the International Public Sector Accounting Standard they claim to be aware of is also not yet embraced in practice. This is not good for public sector accounting in Nigeria. Proposed Pension Reform Act. In realization of the fact that there is no perfect law anywhere in the world, few months after both the Senate and House of Representatives passed the Pension Reform Bill 2014, President Goodluck Jonathan signed the bill into law. In this section, the salient issues in the new Pension Reform Act 2014 which repealed the Pension Reform Act 2004 is highlighted. Upward review of rate of pension contribution. This upward review of the rate of pension contribution is aimed at providing additional benefits to workers' retirement savings accounts and thereby enhance their monthly pension benefits at retirement. This provision is commendable especially as the aims of the pension scheme are to ensure that every retiree is financially independent to enjoy pleasurable retirement as well as assist improvident individuals by ensuring that they save in order to cater for their livelihood during old age, among other things. Access to benefits in the event of loss of job. The proposed Pension Act 2014 has reduced the waiting period for accessing benefits in the event of loss of job by employees from 6 months to 4 months. This is done in order to identify with the earning of contributors and laborers. In this study session, please note the following. 1. International Public Sector Accounting Standards as issued by the International Federation of Accountants Public Sector Committee. 2. International Standards for Supreme Audit Institution. It is a truism that the absence of a universally accepted definition of the term adoption has tended to generate varied responses to the adoption of international standards for supreme audit institutions. 3. Public sector accounting in developed countries. These countries have reformed their accounting and budgeting systems by shifting from cash-based accounting systems to accrual-based accounting systems, from cash-based budgets to accrual-based budget systems, and moving from separate accounting reporting to consolidated financial statements. 4. Developments in public sector accounting in Nigeria. As of today, the modified accrual basis of accounting alongside the cash basis is expected to be in use in the Nigerian public sector. This is a step in the right direction in terms of progress in public sector accounting.